Good morning. This is actually a great pairing because here we have a guy who's going to tell us how the markets are rational, or maybe they're not. And then here we have a guy who's going to tell us how our brains are wired in a way that makes us react to those markets. So I think it's going to be a pretty good little conversation here. We are going to go, I don't know, half hour, 35 minutes between the three of us having a conversation, and then we'll open it up for some questions to wrap things up. So bear that in mind, and when your time comes, just raise your hand and speak real loud, and we'll see what these guys have to say. We'll start with you, since you were above the title on the invitation out there. So
yeah,
you're,
I don't know
you're
how
the
that
guy.
happened. Yep.
Title of the book, obviously, is The Myth of the Rational Market. And then I'm going to start, as you might imagine I'm going to start, by asking, what is this rational market thing and why is it a myth? In layman's terms.
Right. Well, shockingly, I actually thought about that this morning in the shower, that someone might ask me something like that. It's two different things as I think about it. It's basically this set of ideas about how we understand financial markets in particular that has sort of been present in mainstream economics for more than a century, but really was codified and formalized at the University of Chicago and MIT in the 1960s. And part of it is just this view of the market as composed of all of these rational, calculating individuals who are just always out to do nothing but maximize their own wealth. And that's a really useful construct, but I think as Paul will tell us later, that it's not the whole story. Actually, there are certain things that don't fit into that purely calculating mode that seem essential to making markets work, from entrepreneurs taking risks that aren't actually reasonable and rational, to trust, which is Paul's area. So that's one thing, and that's sort of the more scientific definition of it. The other is just there got to be this worldview over the past 30 or 40 years that financial markets knew what they were doing and did a pretty good job of setting prices all of the time. And I just think, I think they do a pretty good job most of the time, but clearly there is this occasional tendency of financial markets to go nuts, either with excitement and enthusiasm on the upside or just utter panic on the downside.
Just to ground this on our own recent experience for a second. You say in the book at some point, I was looking through it the other day, the decline in the market that we had after Lehman Brothers went under. As nuts as that seemed to everybody who was looking, it was actually rational. Because things really were bad.
Yeah, I think actually the stock market behaved a year ago pretty well. It didn't anticipate everything that was going to happen, but clearly no one fully anticipated that. But once things started happening, you watched the behavior of the stock market. It never stopped functioning. There was always liquidity. People were always buying and selling. So I give the stock market a pretty good grade last fall. Last fall's financial crisis was purely about debt markets, that a whole bunch of them just went from one day people are willing to lend each other money and do business with each other, to the next where suddenly there's no market anymore.
There is probably no beast in this economy that is more susceptible to the follow the herd mentality than the market writ large, right? How come? If it's supposed to be so rational, how come?
Right. So, there's two views on that. One is that markets are irrational because people are irrational. That's a possibility. We're not perfectly rational. The second is that markets have their own momentum. So in situations...
Financial markets in particular.
Financial markets in particular with high volume. So when there's lots of uncertainty, when we don't really know what's going to happen in the future, we do what we do as normal human beings. We say, well, what is Justin doing? What is Kai doing? What is my friend Bob doing? So if that's what's going on, if these guys are so smart, I should do the same thing. So we see a lot of this kind of herding behavior, which generates market bubbles. So what's interesting is that we all kind of knew this was a market bubble. Mm-hmm. Real estate prices couldn't be sustained. There were way too many loans going out. And yet the only rational thing to do in an irrational market is to be irrational.
Say that again.
So I think the only rational thing to do if you have money in the market, when the market's irrational, is to you or yourself be irrational. That is, you don't want to get out too early. If you're an investment professional, you can just stay in the market, right? So this generates this momentum to actually have these bubbles explode and then burst.
And this is why my job is so great, because I get to explain this every single day. Right? Think about that. Give us the 45-second historical version of where this theory that the markets know what they're doing, that the price the market sets is the right price. Where did that come from? How did we get there?
45
45 seconds, seriously.
Okay,
I know it took you 300
No,
pages
I
in
mean,
the book, but.
first of all, I think ever since there were financial markets, people noticed this remarkable ability they had to sort of weigh things and look into the future and sometimes anticipate what was about to happen. So that's been there for a long time. But what happened in the 50s and then the 60s was, I think, a whole lot of people economists who had learned statistics a lot better than economists had before and had a higher level of math skills, were sort of able to draw up this model of how the world worked, in which, of course, the market did that, because that's how their models worked. And then the one sort of practical element of it was that in the 1960s, there were all of these go-go mutual funds that were really getting lots of publicity, going up 30 or 40% a year, and a lot of these finance professors and economists sort of raised their hand and said, we think they're only doing that because they're taking risks that they don't fully understand. They're not actually beating the market, they're just taking crazy risks. And so a lot of it was sort of this practical project in the 60s to show that it's not that easy to beat the market all the time.
Yeah, it's interesting. So I was, as I said, going through the book again the other day, and I flipped to the back where you have basically a cast of characters, right? Really heavily loaded with academic mathematicians and economists. And the thing I kept thinking was, where's their real world experience? I mean, these guys make all the models, but then the market, personified by investors and traders and fund managers, they go out and do what they feel in their gut. I mean, how does that make sense?
Well, I think the idea was that these traders who relied on their gut, by the late 60s, early 70s, were all looking pretty stupid. And so they were, because the market in 73 and 74 was just horrendous, the stock market. And so they were looking for answers. And suddenly here are all these 30-year-old finance professors who have we have the capital asset pricing model here, we have modern portfolio theory here, let us tell you what to do. And, not everybody was receptive to that, but more people were receptive to that than you'd think. And also, we had sort of the rise of pension funds in that period. Mm-hmm. And a pension fund trustee, it's sort of nice to have some academically accredited theory to follow rather than some guy's gut.
Yeah, you are an academician. I mean, you're a practitioner, but you're in the academy, as it were. What do you guys know about real world markets? I mean, Well,
I'll tell you what we do is we put students in experiments and put money in the line and have them trade assets for real money. And guess what? Every time you do that, bubbles occur. So we ask is, what's the brain mechanism behind that? Yeah. We find this kind of overactivity when you see a line going up in areas of the brain that are associated with desire for food and sex. Any reinforcing behavior is also reinforced by markets. So what's to say? Take more and more risks. So we see this all the time. So it's a natural behavior where creatures that need resources are important. So we have these old parts of our brain that aren't the rational part. They're not the cognitive part that drive us into getting excited about prices going up.
So what does the brain look like when those prices start going down? What happens, neuroeconomically?
That's right. So two things happen. One thing happens is denial. How could I be wrong? Me, I'm a wonderful investment professional. I spent all this time. Of course I can't be wrong. I don't want to cut my losses. And so you get attached to this. We call this the endowment effect. So
I'm sorry, the endowment effect?
The endowment effect.
You endow yourself with great powers, blah, blah, blah.
Well, you've chosen this portfolio of stocks, and now I love them. I'm in love with my stocks. They're part of my personality. I chose them. There are ways to get around that, as Justin talks about in the book. And I have some kind of model, informal model or formal model. And the second thing is then this loss aversion. Once I've realized I'm burned, I want to get out of the market. I want to go away from this. I feel the pain. And so then we get these swings. So the first is everything's great. Lines are going up. I'm happy as can be, making tons of money. Everyone thinks I'm a hero. And the line goes down. I can't be wrong, can't be wrong. And then once I figure I'm wrong, I want to get away from this as far as possible. So now I have, instead of this kind of smooth, I have these much larger swings than possible. So it's part of this old evolved brain that we share with lizards.
Lovely. I feel so much better now. So where are we now? I mean, if you look at the economy and the stock market and the financial markets in general, where are we?
So I think where we are is just where Justin said. We have these models that work 80% of the time wonderfully. They predict well, say people are thoughtful, and even if individuals are irrational, markets can be rational. They can essentially average out the bad stuff. Right? So the question is, how do we suppress this kind of animal instinct to get away from fear or seek out the coolest fruit tree on Wall Street.
Yeah.
So I think that requires some models. It also requires kind of self-control. I have to understand how to do this. So practical example. Something that some brokerage houses have done now is to have Justin choose a portfolio, but have me manage it. So I don't have that endowment effect. I don't feel attached to these stocks that I did research for 3 months on. I'll cut those. Just Justin stocks.
And does it work better?
It does work better. So a number of places have found that this is a way to get rid of these kind of cognitive biases.
Well, over the course of doing this book, I steadily moved my investment portfolio out of my own hands, which is
Oh, is that right? That's fascinating.
interesting.
Mine's in my wife's, and I'm fine with that. So, let me get back to this thing about how can I possibly be wrong. Alan Greenspan went up to Capitol Hill last fall, and in essence, after 20 years of running this economy, said, oops. He was a huge believer in the theory of rational markets, wasn't he?
He was, and actually he was a nuanced believer in it. He believed there were bubbles. He didn't deny that these things could happen. He just thought, it's not my job to try to prick them. And basically he tells this in his memoirs. He did very consciously try to prick what he thought might be a incipient market bubble in December 1996. He gave this speech where he used the famous phrase irrational exuberance, and markets around the world fell for like 2 days. And then they just started going up again. And the lesson Greenspan took from that is, I'm not smarter than the market. I'm just going to back off. And to some extent, there's something, that was intellectual humility. But it ended up turning into this thing where he was really involved in 2003, 2004, 2005 in studying the real estate markets. He was even writing papers with this Fed economist about how much money people were extracting from home equity loans and spending on TVs and whatever. And so he was watching it very closely. He was obviously somewhat concerned, but he just sort of figured, we have these great securitized mortgage markets. We have derivatives markets where people are betting on both sides of this whole matter. They know better than me, so I'm not gonna jump in and try to do anything. I mean, obviously the other thing is if he'd jumped in 2005 and said, "Hey, party's over," there would have been a downturn, and everybody would have blamed it on him. And now we got a downturn. A lot of people are blaming it on him anyway, and it's worse than it probably would have been in 2005. But I think it's sort of understandable human reaction not to want to be blamed for that.
Yeah, I can't remember. I have to admit if I read it in your book or someplace else, but there's this conundrum with the Fed trying to prick those bubbles and regulate them, right? Because part of what they do is try to boost the economy and keep it at a certain level, but they don't let it. They aren't able to prick those bubbles, so it just keeps going up, right? They can't prick the bubble, and then they support it from behind, and so it's a self-fulfilling circle.
Well, and it's this really asymmetric thing because they do jump in when suddenly markets are freezing up, and they're very active.
Right.
So it's this, okay, markets are irrational on the downside, and therefore we need to do something. But on the upside, we don't know better than the market, so therefore we better stand back.
Yeah.
And that's just, you just got to think about that for a minute, and that's just this formula for more bubbles.
Yeah.
And I think that's what they've realized. I don't know what the right answer is there. There are definitely lots of people at the Fed talking about, well, what role should we play in pricking bubbles? But the Fed in the late 1920s, in 28, 29, tried a little bit to prick the bubble, and you talk to lots of economists today, and they say, yeah, the 29 crash, that was the Fed's fault. Trying to prick the bubble. So I don't know, I have a certain sympathy for those guys.
And it's interesting, Bernanke's on the Hill today, as a matter of
Yep.
fact, getting grilled about that whole thing. Back to Alan Greenspan. There is nobody probably whose reputation for handling the economy was one of being as completely bloodless as Alan Greenspan. He was emotionless, he was steady, and in part that was calculated because every time he hiccups, the markets move, right? There is a role, away from the neuroscience for a second, there is a role here for emotion and gut, right?
Sure, absolutely. And in fact, it's very hard to make decisions without having that feeling of what's going to happen. So patients, for example, who don't have intact emotional centers are very bad at making decisions. It's got to feel right. And yet I think we have this sense that we want someone to be in charge. And I think, as Justin talks about in the book, there is a sense in which markets have their own momentum. They have their own, it's like a wave in the ocean. You can't really control it. So you can regulate it. The sense in which it has its own momentum, and some of that is driven by emotion. So having Alan Greenspan, quote, bail us out, or Ben Bernanke, I think is not what we really want. We want to have a stable set of rules, have people optimize around those rules, and if bubbles occur, arbitrageurs will make money and that bubble will disappear. There are costs. I'm not saying there aren't costs to that, but I think we have an inflated sense of how much control the Fed or the Treasury has on controlling markets.
Right.
They have their own momentum. They're very hard to control.
Well, and what might be better is constructing a system, a financial system that can handle bubbles and crashes more. And that's what, actually, I heard Myron Scholes, who's of the Black-Scholes option pricing model and a Nobel Prize winner, long-term capital blow up guy. But he's talking a lot now about this idea that, gee, if we only had more flexible debt contracts, that, okay, you've got this real estate loan, but if there's a market-wide implosion of commercial real estate, suddenly the loan value gets automatically marked down, and that's decided from the beginning. Then you have much less of this risk of freeze up and collapse.
Well, let me go all the way out there then and completely blue sky this thing. What if we just didn't have the Fed? And what if we just not let the market run free, but, didn't try to do all this stuff that Ben Bernanke spends every waking hour trying to do?
I want to try that one. I've been doing a little survey at professional meetings of economists, and I would ask economists, how many people think the Fed does more harm than good? And that number is well over 50% now.
Yeah.
So
Yeah.
I think to have, 12 old guys sitting in a room setting a price has never worked anywhere.
Right.
Didn't work in China, didn't work in Soviet Union. There's really no reason for the Fed if you have good financial regulations. So let me give you a concrete example of that. Real estate bubble, not surprising, you push interest rates down to zero. It's free money, right? Why not invest in whatever you can, particularly leverage investments that require debt, like mortgages? Where was there not a real estate bubble? Dallas-Fort Worth. Why? State regulation that you actually have to put 20% down. You can't get 100% or 120% loan like you can in California. That's a regulatory issue. It's easy to solve this with the right regulations.
I guess, the one thing is we had financial crises and crashes and really horrible depressions before there was a Fed. So while I agree the Fed maybe has reached this point where it's doing more harm than good, I want to argue against sort of the Ron Paul argument that there was a perfect world before the Fed came along and they ruined everything. I guess the one problem with that is you do need some way that you regulate your money supply. And it used to be you just link it to how much gold there was in the world. And by the early 20th century, I think a lot of economists had decided, that's a pretty random thing to link it to, especially because gold supplies don't grow that fast and they grow really fitfully. So that's the problem with the gold standard. Later on, Milton Friedman had this idea that if you just sort of automatically have the money supply increase, and that sounds great, except it turns out it's really hard to measure what exactly the money supply is. So I think that's been you need some mechanism for regulating the money supply, but at the same time, the temptation, if you put it in this group of people, is that they're not going to want to see themselves as just these people with trying to keep the spigot open. They're going to want to jump in and save everybody.
So let me put you on the spot and ask you about some of the proposals that are floating around on Capitol Hill now. Barney Frank's House Financial Services Committee passed its version of new financial regulations yesterday. Chris Dodd is working on his. Should we clamp down on the Fed and, as Ron Paul says, make them open their books and then take them out of bank supervision and really just get them back into the, your job is to manage inflation and get us close to full employment, full stop.
The one problem with that argument that that's all the Fed does, it's a little ahistorical because they were formed in reaction to a financial crisis in 1907 and the feeling that we needed, and it was partly about regulating the money supply, but it was still, we created a central bank in part to deal with financial crises. Right. So purely keeping out of that, I don't know. But the rest of it, I think we can reevaluate what we do with the Fed. I don't know what exactly the oversight and the audits and Congress watching the Fed more closely. I have trouble seeing how that's going to make it do a better job. But I do agree that there's no particular reason why the Fed needs to be in the bank regulation business. And it's actually, we have such a bizarre bank regulatory system. I used to work for American Banker in my youth, and I won't go into the details. But
there are, 5, 6 federal banking regulators? At least.
The OCC, the OTO,
right. Right. The proverbial alphabet soup.
Yes.
Right? So there was, back in last fall, there was a lot of talk about, we've never seen anything like this before, and we've never had this kind of thing happen. When, of course, really we had. It's just the folks who were working on Wall Street aren't old enough to remember 1929 to 1938. It's this phenomenon called recency bias, right? How do we engineer ourselves, I ask the neuroeconomist, so that we can deal with things like recency bias and not be so captive to our own immediate experiences?
Right, so I think one thing which comes out in Justin's book is that the models have value. So what you don't want to do is watch the TV, always tell brokers, turn off CNBC, don't listen to rumors, most of that is just fluff anyway. Follow the trading rules. So if you follow the rules, you move it out of the realm of letting the emotions drive it. Oh my God, everyone's buying Bank of America, I have to buy this now, to what's the model say? So these models can be refined, they're getting better and better, particularly this area called behavioral finance, which includes aspects of psychology. And I think neuroeconomics is beginning to make insights also into the kind of maladaptation that our brains have when we're in high volume trading situations like in markets. So if we can understand that, the models get better and better, and there are firms that are going to wash out, layman washed out. These firms that take a lot of risk that don't pay off are going to wash out, and the firms that kind of follow a strict strategy and update that strategy as the markets evolve, I think are going to do well.
Let me ask you actually about Lehman Brothers and the decision that Henry Paulson and Ben Bernanke and Tim Geithner made to let it fail. And this is a little bit sideways to the hypothesis here, but was that a rational decision?
Yeah, I mean, it's funny because they all say, no, well, we had no choice, it wasn't a
Yeah.
decision. But it was very clear, especially from Paulson in the days and weeks beforehand, that he's like, dang it all, I got all this crap for bailing out Bear Stearns, and I took Fannie and Freddie, we didn't have any choice because everybody figures they're part of the government anyway. Here's where I draw the line. And that's partly just a person trying, that's emotion, but I think there's also some rational thought behind that. Like, we can't just keep bailing everybody out. We have to say at some point, okay, you took risks, you fail. And I think what they didn't understand how everything fit together, because no individual understands how all the linkages there are out there in markets. So I got to say, right before Lehman failed, if I were in that position, knowing what they did, I probably would have let it go too.
What do you think?
A lot of politics involved. Humans are political creatures, and I think to the extent that the regulations are drawn by political expediencies, you don't get the best policy.
What was the role of fear, right? Because last fall was just flat scary.
No question about it. And everybody in the room knows that. Very, very scary. So again, when you're fear mode, you pull in, your focus narrows. You're looking at the next 2 hours or the next 2 minutes. You're not looking about what's good for the economy the next 3 years. So fear has to be modulated. And yet, if you're in markets, you know that you're facing this fear every day. You're seeing volatility, and you can ride that volatility. Again, I think the surfing analogy is right. You want to ride that volatility, make money on it, without having it scare the pants off you. So I think from the regulator's perspective, there was a fear that this domino effect would happen. And so they got to be very narrow, very focused. We're going to bail some people out and not bail others out without looking at the long-range implications. So economists call this a moral hazard problem. If you start bailing everybody out, then it means for the next crisis, take more risk, because if you're wrong, this is a savings and loan crisis. If you take risk and it pays off, you're a hero because your stock goes up like crazy. If not, you get bailed out. So the incentives are really perverse here because we have political things we have to meet.
How did the theory of the rational market affect regulators, and how did that help get us to where we got to last fall?
It's hard to draw a straight line, and a lot of people do. The Financial Times opinion page, seems like every week there's some other guy saying this is all efficient market theory's fault. The argument is simply that regulators came to believe this story, that financial markets in particular did a really good job of weighing risks and sort of balancing things out. And so some of the concerns they'd always had about banks, they all knew the risk of bank runs. They sort of figured, well, all these banking functions are being done in sort of relatively open, free markets, so that risk isn't there anymore. And it turned out this whole new banking system had been structured through securitization markets, derivatives markets, and it was just as subject to everybody panicking and having a bank run as they had before. So Gene Fama, who's the author of The Efficient Market Hypothesis, he's a Chicago finance professor. He keeps writing, it can't be the efficient market hypothesis' fault because nobody on Wall Street believes the efficient market hypothesis. And there's an element of truth to that, but I do think in some sort of not very precise way that regulators believe to a certain amount in the efficient market. And I think most people in markets have this belief that, they have inefficiencies that they can beat, but that on the whole, the markets in which they're participating are serving this really valuable purpose of setting prices correctly.
So play it forward for me and tell me what the next market theory is. There must be some germinating out there, right?
I heard a great one from Myron Scholes the other day, which is the dog-man market theory, which is basically, yeah, exactly. It's a guy walking his dog. The guy is rational economic man trying to make good calculations of the prices. The dog is all these behavioral tendencies, pulling prices off to the side. So he's walking along the path, and most of the time it goes off the path a little bit. Pretty soon the man pulls the dog back on the path. But then every once in a while you have a crisis and the leash breaks. So I don't think that will replace it, but
And the dog goes off in the bushes and
and then the dog runs
doing the
away,
bushes,
and then the
right.
man eventually goes and gets it, but then suddenly they're on a new path. So there is no reality that markets are reflecting anymore. It strikes me, that's one of the I thought in my book.
You heard it here first.
Exactly. Well, yeah,
Second, maybe.
Second. In my book, when I started it, I thought it would be this very clear story of the rise and fall of this hyper-rational view of markets and its complete replacement by behavioral economics and behavioral finance. And I don't think that's happened. I think behavioral economics has all these just fantastic insights about individual behavior, but there isn't some new behavioral theory that explains everything markets do. So what we've got instead is this sort of looser, little more humble version of the efficient market as the beginning model of how you think about markets, and then lots of people doing really interesting research about. And I would love to hear Paul tell me that there is.
Here's your chance, man.
Right.
Do it.
So I think it's really rational plus. So it's taking the rational markets as a limiting case, and for some reason economists have this fetish because the mathematics are beautiful with this sort of rational markets view of the world. It works out nicely, but now it's really adding in these additional factors. When markets are highly trended, people will get overexcited. When there is fear, people will get overly pessimistic. So I think understanding this and actually seeing how real traders have made money on these market swings tells us that this kind of theory has value. So Andy Lowe at MIT has called this the adaptive market hypothesis. We're adapting to the kind of market we're in. Sometimes it's nice and clean and markets average everything out and take out the irrationalities. And sometimes you have these episodes in which you have a great amount of emotion driving, what looks like driving markets.
So it seems to me what you're going to have is this beautiful economic, rational, or adaptive market theory that you can lay out in a formula, and then you guys are going to come in, the behavioral economists and neuroeconomists are going to come in with a big fat X right there. You just can't define, right? Because you can't. How do you quantify this
Well, you
stuff?
can. It's actually been done. There's a hedge fund here in LA that is run by psychiatrists that actually is quantifying different emotions. And so far, they're doing pretty well. So people are trying to do this. And I think the rational part is that for any possible ability to make money, people will find it. They'll find that extra explanatory factor that raises their alpha. They'll find the loophole in the law that allows them to take advantage of the system. And that's how we learn. And we have to just understand that there are going to be failures again and accept it.
Okay, and then those failures, are they going to get us back to where we are right now, having had 20 years of rational market theory bite us in the fanny?
Well, I think we're getting better, right? So we've learned inflation is not a panacea. Inflation's a bad thing. We should try to avoid it. I think we're learning, as Justin said, that regulations are very important in financial markets. They need to be adaptive regulations. They need to adapt to the environment we're in. They can't be static. So I think we're getting better and better. We're getting less stupid over time. That's a good thing. We're not getting completely smart.
Right. How smart can we get? Is there a way to figure this out? It sort of seems to me, based on your book, that we really can't. We're just going to have to.
Well, no, in the end, because markets are us.
Yeah.
And so as soon as we've figured them out, then they'll figure us back out. That's sort of it's kind of interesting because, again, one of the whole argument these finance professors were making back in the 60s was that some guy with some chart theory of, the head and shoulders movement of stock prices, that couldn't always be right, because if everybody started following that theory, then it wouldn't work anymore. What they never really got is that was sort of true of their own risk management theories and efficient market theories, that if everybody started believing them, then they'd stop working. And I think they all realize that to some extent now, but that's just markets. Markets are us, and that's kind of the reason we will never perfectly understand them.
Which means markets are you guys too. What do you want to know? Raise your hands if you've got a question. We'll see what these guys have to say. Don't be bashful. Yes, sir.
Given that the market movement,
Hang on just one sec. Let's wait for the microphone.
Good morning. Good morning.
Good morning.
Morning.
Yes.
Given that the market movement over the last, let's say, 11 months has been fairly unusual, anomalous, one might say, would you characterize it as rational?
Well, the market's going up, so it must be rational. I mean, it's that classic thing where there's elements of, in early February, a lot of people thought the financial system was about to completely unravel and every bank in America was going to go under, and, it may still happen sometime, but it hasn't happened over the past year, so it's perfectly rational to have a bounce upwards. But there's this tendency to overshoot, and it's exactly it's partly what Paul's talking about, that everybody watches what everybody else is doing. All the people who were suspicious 6 months ago, especially if they're professional money managers, are starting to get questions from their clients about, dude, the market's up 30%, you're flat, what's going on? And then the other issue is just, it's what financial markets are a bunch of people all trying to predict the future. And that's just really hard. They're always going to be wrong a lot. So there's elements of rationality in it. I got to think by this point it's elements of herd behavior too.
This is a gross oversimplification, but basically, for a neuroeconomist or your subjects in the lab, up is good, down is bad.
I don't think so. I mean, you can make money going down. I think there's this old saying, the stock market, buy weakness and sell strength. And I remember doing an interview about a year ago for a financial publication, and I said, this is amazing amount of bargains. And the journalist said, do you really believe that? I said, yeah. She said, how do I know that? I said, because I'm buying like crazy. I bought real estate, I bought stocks. There are great bargains to be found out there. So, you have to be able to embrace the fear. And I think that's when it really gets fun and exciting. So I think what we've seen is some of this fear resolving. So you've got to embrace the fear and just know that that's how you make extraordinary returns, is by living with the fear. If you can't do that, outsource, buy the index fund, have a professional invest for you.
Interesting. Yes, ma'am.
All right, so there's multiple layers to this question, but I'm approaching this from being involved in the business school. And one of the things that I'm hearing more and more people on the business in the MBA world talk about is teaching the history of management, or kind of going back. Because I think what we're talking about today is something that we could have been talking about in the 20s and 30s, or we could have been talking about in London about 300 years ago, and the tulip bubble, or whatever. We seem to, as humans, really like to repeat our history and then act shocked. So if you as experts in this area were to say, what would be the things that we need to be now thinking about in our business schools today that we would be preparing the next generation for, so that they may lessen the shock and mitigate some of the fear that Paul is talking about? What else would you suggest that we would cover?
Well,
Go ahead.
a couple of things. One is that we're actually at about the 50th anniversary of these two famous reports that utterly changed business school education in the U.S., one from the Ford Foundation and one from the Carnegie Foundation. And both of them sort of looked at business schools and thought, and what was taught, which at that point was very anecdotal, a lot of I don't know if it was history so much as sort of case histories, and very little systematic scientific approach to management education. And both the Ford Foundation in particular gave lots of money to business schools like at Carnegie Mellon and MIT and Chicago that were willing to push this more scientific approach. And finance was sort of led the way here, the efficient market theory and capital, that led the way to this very scientific way of looking at it. And there's a couple of the sort of founding documents of modern academic finance are these papers by Franco Modigliani and Merton Miller in the late 50s, early 60s. And there's one of them where there's just this moment where they take this little aside and say, we know there have been bubbles and crashes in the past, and there'll be again, but for the purposes of solving this particular problem, which was about dividend policy, the cost of capital, let's ignore those. And that's, to me, that's totally valid, and if you put that in the paper, that's great, but then it created this whole discipline that was based on ignoring those. And so I don't know quite how you fix that, because I think finance professors, I've looked, and they get paid better than any other people in academia, and that's partly because they've created this science of finance, and I think there's a lot of value to that, but it's got to be leavened to some extent with this sense of, okay, this explains 80% of the world, the other 20% matters too, we don't have an explanation for it, so have a history class.
So I did an interview the other day with Ken Rogoff, who's an economist at Harvard University, and he's out with a new book called This Time is Different, about the history of these bubbles and how we are doomed to repeat it. And he relates an anecdote as to how they found the title of this book. And some guy said to him in a conversation at one point, more money has been lost on those 4 words than on any crash, any speculation, anything in the history of finance. This time is different. Right? Because we can't break that cycle. And I think that's just fundamental human nature. I don't know.
Absolutely. And I think, as Justin said, I think understanding history, understanding our own biases are important to recognize this as almost self-management. Right? If I make $1 million a year, I'm not a guru. Right? I am just another working guy, and I've got to use all the tools I can, understanding that we're going to make mistakes, and we're going to try to rebound from those is important.
So is there a way, to her point then, that we can change MBA education or higher finance education, right? Because a lot of these guys are the quants, the PhDs and all this. Is there a way we can do that?
I think it's balancing, as Justin said, the difference between having the models, which are very important and are predictive much of the time, understanding when they fail and why they fail. And starting with history is a great way to do it, and then testing that in markets. I know a lot of business schools now will have, particularly finance students, trade in simulated markets, for example, using the real New York Stock Exchange, and actually test out your theories. I think that's one of the beautiful things about finance is you are tested every day.
I just have one tiny little addition, though. You're asking about, is there a way to change it? And on our side of the fence, on the education side of the fence, perhaps what would be something that would be an impetus for us to change would be the company's expectations of the outcome for students. They would have to have a higher or different or measurable understanding of what they wanted, because they all say they want these quant-trained people, but it's easy to train quant, but the softer skills, the skills that give them the analytical or critical thinking skills are not as emphasized. And I think that if a company said, darn it, this is what we want and we won't hire it otherwise, that's what's going to do it, because we have to be market-driven, I feel.
Yeah, no, I think that's a fair point. The problem is, you got to change the demand curve, right? You got to change what these schools are asking for, and what the companies are asking for, and what they're asking for now is people who go out there and make them a whole boatload of money, and that's a tricky thing. Yes, ma'am.
You don't have to repeat this. I came in a little late if you already spoke to this, but this is a global economy, and you've talked mainly about the United States, but we're already hearing about a possible bubble in Hong Kong and Asia because of the housing prices there, and then also what's happening in Dubai. And I just wonder, in the context of this conversation, can you speak to these two issues?
Sure. Were you surprised at the blow up in Dubai at all?
I mean, when I read the headlines, it was
There was
news
a wow,
to me.
yeah.
It wasn't, I hadn't been, but you think about it a little bit, and no, I mean, it's this place that's been building like crazy, and I think, again, there's a long history of places that have built lots of buildings very quickly, having commercial real estate busts. And that's basically what's happening in Dubai. I mean, clearly, there are these massive efforts going on to try to ease the blow of this financial sector crisis in Europe and the US. And it basically consists of throwing lots of money at it, and that money is going to flow somewhere, and yeah, maybe it's apartments in Hong Kong. So you end up creating, one hopes, smaller side bubbles that, when they deflate, aren't a total disaster. But I mean, that's part of what Paul's talking about. There's going to be lots of collateral damage to our rescue effort. I still think, given the position we were in last fall, it probably made sense to do some kind of rescue effort.
But we're not done yet, right? I mean, her point about the bubble in Asia is well taken.
Right.
There's lots of money out there. It's basically free money. I mean, we're not completely free and clear yet.
No.
And we have seen the correlation between different stock markets increase over time. So the world is getting more and more globalized, which suggests more contagion effects. So this is going to play out. We're going to see this now in commercial real estate, which is going to be the next shoe to drop. There's going to be ripple effects for a number of years.
Well, and actually, this is a classic example of finance professors giving advice, which is sound advice, which is, find uncorrelated asset classes. And that's the only...
English.
Well, I'll go to that. The only free lunch in investing is find things that, so you got most of your money in the stock market. Well, find something that goes up when the stock market goes down and goes, isn't following the same path. And so people have been doing that with asset class after asset class over the past 30 years, from, international stocks to emerging market stocks to real estate, liquid real estate investments to, timber's been a huge thing over the past decade. And the issue is, once everybody does that, then they cease to be uncorrelated for the most part. There are some exceptions, like gold, I guess, but who knows, now that gold is sort of getting
Like
established as,
$1,215 an ounce
Yeah.
or something, yeah.
it may go down with the markets
Crazy.
too.
Ted, I think we got somebody in the front.
Hi, I haven't spoken this morning. Good morning, you guys. And I have to say, Justin, I went to bed with you last night. I opened up a Newsweek and
Time.
there you were.
Does your wife know about this?
My husband doesn't know. But I have to say it's...
Does now.
Yeah,
Right.
exactly. Or will in 3
In
weeks.
3
when
weeks,
this is,
yeah.
yeah.
I think the whole thing, the living in this particular time right now for me is particularly interesting because I'm trained as a business student and I'm trained as a psychologist and I work as an advisor, and my clients are either at one end of the spectrum or the other. Everything's free, like you were saying, there's bargains, or the world's gonna blow up and I don't know what to do. And, I can have a macro conversation with them up to an extent, explain to them what's going on, this is what's happening. But at the end of the day, they absolutely have to feel comfortable with the world. They'll say, Diane, I trust you, but I'm not sure about everything else. What do we say to people who are in those type of situations?
The first thing is, I think it's good not to be completely comfortable. I
Yeah,
think
right.
that's always what breeds trouble, is when everybody feels like they understand how the world works, but at the same time, if everybody's in a state of complete confusion, then nothing gets done and nobody invests in anything. As to what, I'm going to go to Paul, I'm going to punt to Paul here in a second. I guess the one thing I would say is, you're not alone in your confusion, people. It's not unique to you.
Get used to that,
Yeah.
that whole not comfortable with the world thing.
That's right. So great individual differences in the way people associate risk aversion. We've done a variety of studies, for example, showing that a particular region of the brain near the ear codes risk aversion, and there's great variation across individuals. As you know, women tend to be more risk averse than men. They have lower car insurance rates because of that. They don't die as much as men do for certain ages. So I think this is almost an existence proof for finance professionals. This is probably something you want to outsource to someone who spends all their time thinking about this problem and can design a set of portfolios that'll make you sleep well at night. So I think if you're stressed out, if you think there's bargains everywhere, you ought to be careful. If you think there are, the world's going to hell in a handbasket, you also ought to be careful. So there's probably something in between, but this is what your job is, which is to find that portfolio of stocks, bonds, real estate, whatever it is that makes this person comfortable and still earns them a reasonable return.
Ted? Yeah.
Hi, I had a question. So by implementing all the new regulations on the money supply and controlling leverage and all these new recommendations that you guys are saying, what are the implications on growth or innovation or opportunity? Doesn't that hinder what helps drive us forward during the good times?
Justin?
Yeah, I think it certainly could. And that's why I think in the end it's sort of better not to be all about pricking every bubble and instead have some sort of, and I wish I knew exactly what it was. Clearly there's some issue with leverage being problematic, because we had this big tech stock bubble and bust, and it was a real pain if you worked for Pets.com, but for the economy as a whole, it was okay. There was a recession, although the recession had other causes too, but it wasn't this huge crisis. And the one thing, and yet then we just had this real estate bubble and collapse, and it was a huge crisis. And what's the differentiating factor? It's that people buy real estate with a whole lot of leverage. People were buying tech stocks with their own money, so they could take the downside. So I really think, and this is getting super kind of tentative and vague, but there's something to maybe finding a way to move our financial system a little more away from guaranteed assets, from debt that claims to be no risk, to just everybody understanding, okay, there's some level of risk, but let's make clear beforehand what the work, how it's going to get worked out if things don't go well.
There's certainly a sense in which, as the rules are changing, it's very hard to get financing. As you know, if you work in a small company associated with a couple of startups, and getting venture capital is just horrendous right now. It's just awful. No one wants to take risk. No one knows what the rules are. And so it's very difficult to have a set of rules that are clear so that people can make 5-year plans on investments, and also have rules that adapt to changing market conditions. So it's this kind of constant trade-off. So now we're in the adaptation phase, which means there's kind of a freeze on a lot of lending. And I think we have to get through that, because once we have that freeze, either two things happen. There's not a lot of new businesses being funded, or that funding funds businesses overseas where the rules are more stable. So having said that, we need to adapt.
But I do think it's stability of rules matters almost as much as what exactly the rules are. You can have pretty strict financial regulation, as we did starting in the 30s, and yet, and it basically lasted through the 70s, and have really high economic growth for part of that period.
It's just important everybody knows what the rules are, right?
Absolutely,
You're going to have them move,
sure.
and we all play by. Yeah. Last one, I think, Ted, yeah? Okay,
Yeah,
sir.
I'd just like to speak to the question of rules and stability that you were talking about, and a couple of other things. Is that it seems to me like the extremely wealthy are controlling this economy. They control the political situation. They're responsible for the elimination of the what was it called? The Stegall Act that was created in 1933, that was erased in 1996 to erase the difference between commercial and investment banks, which is in some sense has been responsible for this bubble. And as far as the rules are concerned, in Canada, the real estate bubble, there has been no real estate bubble. The real estate situation in Canada has not collapsed, because, as you said in Texas, you referred to Texas, and the fact that in Texas you have to be able to put up 20% of the capital on any real estate property you buy. That is also the case across the board in every province in Canada. It's a federal regulation. You cannot buy a house unless you can put up 20% of whatever the selling price is, and that those kind of regulations are extremely important. That the erasing of those kinds of regulations in the United States has led to this problem, that there's a lot of resistance against the Consumer Financial Protection Act, which we heard about.
But I guess what I'd say, though, is that the directions, I would agree that the getting rid of Glass-Steagall, which initially I thought, that has nothing to do with this crisis, but I think there is something to that. That was coming from banks pushing for that and wanting that. In terms of relaxing real estate lending rules, that was actually something, the banks, I guess, we're happy with it, but that was a lot of push from Democrats in Congress for more housing affordability, which turned out to be really just sort of a dumb way of thinking about it. But I would completely agree. I guess what it gets to with me is sometimes long-established rules, even though they don't seem perfect and they don't totally make sense, if they've worked for a long time, they're worth keeping. And with the 20% down on real estate is a classic one. There's no perfect financial model for why it should be 20%, but it seems to have worked in a lot of places for a really long time. And the division of banks and investment banks, there have been 1 million papers written over the past 50 years about how it was senseless and didn't make any economic sense to do that. But somehow or other, it put different kinds of behavior in different baskets and kept a little craziness out of the system.
And we're always subject to the law of unintended consequences. I think that's what happened. They just say, well, here's this policy that will help lower income people who can't afford 20%, so we'll reduce the incentives, allow them to get loans on this, and then what happens?
What could possibly go wrong?
Then you have, no income verification loans. If you lived in LA like I did, you heard 300 times every day on the radio, no income verification, 110% loans on mortgages because you're going to be a wealthy guy. And so once my gardener was buying real estate investment properties, I knew that the bubble was ready to burst, right? That's the last guy who should be buying properties. He can't afford it.
Last one, yes, sir.
Good morning. You both commented that commercial real estate may be the next shoe to drop. Could you elaborate a little bit on that and share what your views are on the overall economy?
And when might exactly that happen? Because my
Well,
broker's.
because that's what I spent yesterday on a tour of commercial warehouse properties in the City of Industry and Pomona, hearing like the financing story on all of them. And clearly, there's a lot of commercial real estate loans at a value that will not be achievable over the next 5 or 10 years. It's just that in commercial real estate, there wasn't the kind of totally crazy lending there was in housing. So people, for the most part at this point, are able to keep making their payments. It's when they have to roll over the loans that it's all going to come crashing to a halt. So it's out there. Clearly, there's some sort of big commercial real estate correction, a lot of bankruptcies, a lot of loan workouts. It's not happening yet very much. It seems like it's something for a year from now, 2 years from now.
Paul?
And those loans tend to be longer term, so that's going to happen with less of an acute effect. It'll roll out over the next 5 years. There are a number of banks that have high exposure to commercial real estate loans, and those banks I would worry a lot about, and regulators certainly are looking at them. But I think this is going to become a rolling factor that's going to play out over 5 years.
Well, Zach, Justin Fox, I thank you for your time.
Thank you very much. Justin will be available to sign his book outside. You may purchase it. Makes a great holiday gift for your rational and irrational friends. And Justin will be on Larry Mantle's show at 10 o'clock today. So if you want more.
11.
11, sorry.
He's not going to make 10.
11 o'clock. Thank you for coming. Our next event will be in January with Jim Wallace. And then we have another one at the end of January with Jane Bryant Quinn, Meg Whitman, Nouriel Rubini, and several others well into the fall. So stick around and have a good day.
Thanks.
Guys, thanks a lot, Paul. Thanks a bunch. Appreciate it. Nice to meet you. You're going up to Pasadena, or are you going to do it from down here?
Go to Pasadena.
All right.